Hello, everyone, and welcome to today's webinar, Understanding and Managing Liability Insurance Needs for Collecting Institutions. I have just a few housekeeping notes to mention. One, if you have any sound or technical issues today, please let me know in the chat box with a direct message, and I will try my best to help. This webinar is being recorded, and the recording, along with a PDF version of the slideshow, will be sent out to all registrants within the next week or so. And finally, we do have some built-in time at the end to answer any questions that may come up, but please feel free to type them in the chat at any point throughout the presentation. Now, before we get started, I just wanted to share a bit about the Documentary Heritage Preservation Services for New York for anyone who is unfamiliar with us. DHPSNY, as we like to call it, is a collaboration between the New York State Archives Documentary Heritage Program and the New York State Library Conservation and Preservation Program, with services provided by the Conservation Center for Art and Historic Artifacts. DHPSNY is a statewide program that provides free planning and educational services to support the vast network of collecting institutions such as archives, libraries, historical societies, museums, and other organizations that safeguard and ensure access to New York's historical records and library research materials. DHPSNY services include archival needs assessments, preservation and conservation surveys, guidance with strategic planning, and access to a variety of educational programs such as this webinar. To learn more about our services, please visit DHPSNY.org. And with that, I pass this along to today's presenter, Andrew Marietta, VP of Regional Development at the New York Council of Nonprofits and Licensed Associate Council Services Plus.
Great, thank you everybody for joining us for this webinar, and hopefully the interesting topic of liability insurance, and hopefully we can get folks to just to share some of your questions or just some general comments as we just kind of have this overview and discussion on understanding and managing liability insurance needs for your collecting institution. Insurance is obviously not the most exciting topic, but hopefully there's some information you can take away from this overview and apply it to your own organization as you look at your insurance structure or maybe even insurance needs, and how best to protect your organization, protect your assets, manage your risks, and kind of fit that within your overall governance and management operations. So I just give you a little background on who I am and who I represent. I am, my primary position is with the New York Council of Nonprofits, NYCON, which is a state nonprofit association for New York and a DHPSNY partner. And our interaction through DHPSNY with organizations is through facilitating the strategic planning assistance. And so if any organizations have applied for that program or are obviously interested, NYCON is a partner in providing some of the strategic planning facilitation. In addition to NYCON, we also have under the umbrella of our organization some subsidiary corporations, kind of our family of services. And more specifically, we have one called Council Services Plus, which is a separate corporation, but again, a subsidiary of NYCON's that is actually a licensed insurance brokerage here in New York State that works with only nonprofits and helps them with risk management issues as well as securing insurance for their organization. And so today in my role, I'm going to be kind of speaking from the nonprofit side in terms of your collecting institution and also from the insurance side, because I actually have a dual role in working for both organizations. So I work for NYCON and work with nonprofits and more specifically museums, historic societies, collecting institutions all across New York State in a variety of different capacities. And then I also work for Council Services Plus as a licensed broker. And I have dual licenses in P&C, property and casualty, as well as life, accident, and health. I work with a number of organizations, all kinds of nonprofits all across New York State, so I'm here to kind of just give some additional information and guidance just around insurance, hopefully in a easier to understand way that maybe from the context of just trying to figure it out yourself, or from trying to figure out it from your insurance policy, or whatever option you have for trying to decipher your insurance and what it means and why you are purchasing it. So just to give you some of that context, and in general, Nikon also has a couple other resources that you're welcome to take a look at. You'll receive these slides obviously as a follow-up, but one other resource I would just mention is Board Strong, which is a board matching platform that has been newly launched and is a great resource if you're looking for an opportunity to, as a nonprofit organization, set up an organizational profile and promote a board opportunity for potential candidates to review. The whole platform has the main goal of bringing candidates, individuals interested in serving on a board, and the nonprofit community together to try to connect. And so you can go there and set up your profile and post that board job opportunity for free, and candidates go there and sign up and basically try to make that connection. So I always try to highlight this resource because I think for many organizations outside of maybe understanding your insurance, there are obviously that's a struggle, but another struggle is definitely finding board members and trying to get them interested in board service. So any tools that are out there are always helpful, and this one is I think has a lot of potential as we work to get more visibility for Board Strong. So that said, there's just a little more context to Counsel Services Plus that does make it very unique in terms of this social enterprise aspect. It being owned by a nonprofit organization, solely working with nonprofits and benefiting the nonprofit sector makes this organization very unique in terms of Counsel Services Plus. So we always like to stress that it does make it distinguish this organization from other insurance brokerages or just other organizations providing insurance assistance. CS Plus is a fit very much within the scope of Nikon and our services around governance and management, which you can definitely, again, take a look at nikon.org for more information on board, the resources and information, and Board Strong as well has some great information and resources around governance and management. But I will mention, as we have our discussion, at least one other resource that offers a lot of great risk management information and resources, and it has a much more closer tie to the insurance industry, and also has a real focus on risk management. And I'll just mention that now, and I think we'll drop that website into the chat. But the Nonprofit Risk Management Center is also another really great resource to take a look at when it comes to this topic of risk management and insurance. And so really, what we're going to talk about today is why we would consider insurance. What's the purpose of it? And then really talking about the different types of insurance that you may want for your organization, and just kind of general understanding what they're geared towards, and maybe some of the ins and outs to them, and then just some general points about managing your insurance, and then that relationship that you have with the insurance industry, but also in terms of the broker you're working with that is providing that assistance, and kind of the role that they play, and so maybe we can get some folks to kind of weigh in here on some of these components as we have this overview, and just see if you know, in terms of just general consensus, if people have any experience with some of these insurance policy types, some of them more specialized, or maybe some just ask you to kind of weigh in on what your general perception of insurance is. That's you know, that's always an interesting perspective to get from people. But in general, you know, what is insurance really about? You know, so really this idea of insurance is reducing the financial uncertainty that your organization might face in terms of an accidental loss, and to make that manageable. You know, so it's kind of transferring that risk. So you're basically making this payment of whatever fee to in terms of premium, that insurance premium, to the insurance company, that professional insurer, in exchange for them assuming some of that larger risk of potential loss, and giving you a promise to pay in the event that there is that loss. You know, so this is really just transferring of risk. You know, it's the idea of insurance is, you know, is to make you whole, you know, in terms of a loss, but not, you know, not benefit or you know, or actually make you better than you were. You know, so there are some limitations to insurance, obviously, and we'll talk about some of that, especially when it comes to property. But you know, all of this is kind of packaged together, and that's that whole idea of liability insurance. That's really the foundational building block. And so a lot of the different components of insurance that we'll talk about always kind of connect back to that general liability or commercial liability coverage, and that's going to be one of the most essential things for any organization to have in place, and so that really gets into why we have insurance. So there's a variety of reasons. I mean, some of it could be statutory, because you're required to by your funders, or by just contracts, or just even just by law. In some cases, there could be an actual legal obligation to it, and that again is on the funder side. Event contracts might require you have insurance. Facility use, you know, rentals, property that you might own and have a mortgage with the bank, they're typically going to require you to have insurance. Donor expectations requirements, you know, that in terms of protecting the assets you have, protecting the collections you might have, or the money that you have in terms of resources for your organization. We purchase insurance, you know, to help manage the potential risk of a loss with those different components that, you know, when you think about the board of directors and the staff of an organization, they ultimately are working together to deliver mission. You know, the reason that a collecting institution exists is it has a charitable educational mission as a 501c3. So that's your most important asset. As an organization, you're delivering on that mission, and you're relying on your assets. And so the board, as a governing authority, are helping administer, allocate, distribute those assets to carry out mission. They take some of those assets, they hire staff if you have sufficient resources to do that, you know, and then board and staff are working in partnership to deliver mission. Those assets and, you know, all the components that support operations, and especially in a collecting institution, you know, your facilities, your collections, you know, everything that you're depending on to deliver on mission, all have, you know, essentially you would want to protect those assets and collections, and that would be your fiduciary duty as an organ, you know, in terms of the board of directors and as an organization, you know, putting the mission of this organization first and foremost. You're, you know, so there's this legal obligation, even from a fiduciary standpoint, to protect those collections, protect those assets, and you do that through insurance. So, you know, and then there's just a general best practices and the, you know, the idea of managing your risk, and insurance makes up that structure, that risk management structure. So we manage our risk through policies and procedures, through engagement, through a board, you know, a governance accountability structure, but we also, insurance is a building block that's a part of that risk management structure. So all of this kind of works together, and we use that insurance piece to you know, to help us as you know, as just a you know, kind of a operational element when it comes to management and governance infrastructure. And so, you know, preserving your assets from potential accidental loss, theft, attracting donors, staff, and board members. You know, insurance plays an important role in allowing the organization to fulfill mission and carry out programs and services and generally operate. And the, you know, other than a potential loss, there's also the liability side in terms of those actual operations and possible accidents or some kind of issue arising where the organization could actually be sued in terms of legal action. And so that's another important aspect of insurance. It's going to provide liability. It's going to provide protection from those potential liabilities and any actual legal action that might result. And so, you know, that side of it in terms of lawsuits, you know, potential legal action. Unfortunately, that's an area that has a lot of examples where organizations have problems and issues, and insurance has been a very important tool in responding. And so when you don't have insurance, or you don't have adequate insurance, unfortunately, that's where it becomes very problematic for an organization. So getting insurance hopefully is a strong, everyone has a very clear idea behind that, and there isn't anyone out there questioning the value of insurance. I think people question the cost of it, but it's, you know, really a necessary part of doing business. And unfortunately, we still find organizations that even in this, even today, in you know, with the potential liability risks that organizations face, that still operate sometimes without adequate insurance, even small nonprofits that may not even see the value of insurance. So that's hopefully that's not a conclusion you'll take away from our overview today. So. And I think, I don't know if at this point, if anyone, you know, has as from your own perspective, I mean, do you, I guess I'll just ask a very broad, open-ended question, but I mean, are there folks here that generally, I mean, from an insurance perspective, I mean, how often are you kind of looking at your insurance kind of makeup, you know, the different types of insurance you have for your organization? Are you looking at that once a year, or are you hardly ever looking at it, and, you know, mostly you just pay your bill when it comes in? I just, you know, if anyone wants to just share that in the chat, because I think, you know, often insurance can, you know, it's a part of doing business, but many organizations kind of just, the bill comes in, renewal comes in, you don't necessarily pay a lot of attention to it, and maybe that's the one time a year we look at it. And so a couple of people weighing in here saying they look at it annually, you know, and so it seems like general consensus is annually. Somebody's just mentioning here that their board president and treasurer look at the policies yearly with their insurance team, you know, and I think that's a great approach, you know, to kind of bring in other people just to look at the policies and make sure that they are a good fit for the organization, and especially in terms of your operations. And another participant weighing in, just saying we start review a month before the annual renewal. So, and yeah, that I think we'll talk a little bit about the general renewal process and some insight into how organizations, especially when working with a broker and the insurance company, kind of how the renewal process can be approached, and how it might be to your advantage if you are looking to basically compare against some other policies. And then somebody's just saying here, they just after disaster strikes. So that's often when our insurance becomes the most important thing we have, and really what coverage do we have, and sometimes we don't want to find out at the wrong time that we have a problem with our insurance. So I'm going to just talk a little bit about some of the different types of insurance, and then then again, as we talk, maybe if anyone has any comments or questions, feel free to weigh in on the chat. But really, as I said before, the kind of foundational building block for types of insurance really is that commercial general liability policy. And that really is, kind of a bread and butter policy, almost an absolute necessity. It is an absolute necessity from a risk management standpoint for any organization that is offering programs and services, and basically operating, as a nonprofit. There's always potential liability. Unfortunately, especially related to legal action that nonprofits face, even for a small volunteer-driven organization that may not have much visibility at all. So it's just such an important piece of kind of the protection of the organization, the assets of the organization, as well as the board of directors. And so what commercial general liability is in terms of its focus, it really is about that bodily injury or possible damage. That's really what that general liability policy is focused on. So bodily injury, property damage, injury from a personal and advertising perspective, products and completed operations is another component, and then medical payments. So these are the components you'll see when you look at your policy, and the breakout, in terms of kind of the general aggregate, the per occurrence. This table to the right is a typical structure that you'll see kind of broken out for an insurance policy, or for your insurance policy. So in general, that per occurrence and aggregate, those limits, that tells you, the most important information of your policy in terms of the overall structure. So typically, most insurance policies have a 2 million general aggregate and a 1 million per occurrence. Now, it doesn't mean you can't get lower limits. Some smaller organizations will opt for a 1 million general aggregate, 1 million per occurrence. But for the majority of organizations, the standard you typically will see is a 2 million general aggregate, 1 million per occurrence. And then you kind of have standard amounts that you'll see. The products and completed operations, the personal and advertising injury, you'll kind of see the products and completed operations mirroring the general aggregate, personal and advertising injury mirroring the per occurrence cost, and then typically you have the damage to rented premises, again typically around that 500,000 amount or a couple 100,000, and then medical expenses. This is what would be paid per person if there was an injury, an actual medical expense resulting from an injury. And so, so what really, what you have to keep in mind here is this is really more about third-party bodily injury and accident. So it's not if your employee was injured, it's typically not if your volunteer was injured. And this is where we'll talk about some of those other insurance policies. But from a volunteer perspective, that's typically the biggest gap for commercial general liability. They really don't. Most insurance carriers do not cover volunteers in any way. Now, there are some specialty carriers that specifically do, well-known, do only business with nonprofits that build volunteer coverage in, but that's a very unique circumstance. So typically volunteers are not going to be covered under your policy at all. And then that's the kind of thing you need to look at your policy language and really explore that. But your employees, volunteers, they're not third parties. So employees would be covered under workers' comp, under short-term disability, depending on the type of injury. If they're injured on the job, that's a workers' comp injury. If they're injured outside of a job, say at home, fell off a ladder, and now they can't work, that's more of a disability claim, short-term disability. So if you kind of see the dots, we're gonna try to connect some of the dots here on how insurance works and interacts with each other. But ultimately, this commercial general liability is really, slips and falls, the most common types of issues that we see for especially for a collecting institution. Depending on your premises, have somebody walk in, a visitor, they trip and fall. That's a general liability claim. So that's the kind of issue. Or for example, say an employee I've had this exact issue occur. An employee is writing something on their personal Facebook account. Somebody in the community felt it was slander against them individually, and that person they felt was representing the organization that they worked for, then takes legal action against the organization. That is a GL claim. That kind of issue arises, unfortunately, all the time, especially now with so much going on online, and especially related to social media. So the general liability protections extend far beyond somebody walking into your doors. And so that's the kind of scope you really want to keep in mind here, and the importance of commercial general liability. And I'll just take a question that came in here. Can general liability cover a sudden loss of revenue that is not your fault? For example, a pandemic happens. I absolutely want to talk about that. And that really is business interruption. And I'm gonna touch on that for sure. And that is a component, depending on the structure of your commercial general liability policy, absolutely can cover a sudden loss of revenue, but there is a but to it. And unfortunately, many organizations found that out when they went to try to make a claim for loss of revenue, loss of income, and as a result of the pandemic. And I'm definitely going to talk about that in a second here. In terms of just a question here about defining completed operations, products and completed operations, that's really more on the operational side, and I guess, some of the terminology that, as you think about insurance in general, it really is geared more in terms of the way the terminology, I guess, is used, is geared more towards like the business sector. So products and completed operations are really the products and services that are being delivered on behalf of the organization. So that general liability policy is providing protections in terms of those services that you're delivering. So, for most collecting institutions, you're not really creating a general product that somebody's going to walk out of the door and come to your organization, buy it, and then walk home and use it. That in terms of products and completed operations coverage. But it definitely is applicable from a programmatic standpoint, in terms of the things that you're putting together within your operational structure and then delivering to the general public. And it could be applicable to some organizations if there was some kind of product that from a product perspective that you actually were creating and selling within your organization. It's a little different than say like a retail gift shop that you might have at your institution, if you have one and you're selling things within that gift shop. Typically, most of the things that would be offered in retail are going to be third-party products, but if you had a product within that gift shop and sold it and say it's some kind of food item and there was an allegation that that food item was bad, that individual who bought that product and then got sick, for example, and it resulted in legal action. If they then went to sue your institution, that is going to be a commercial general liability claim that falls under products and completed operations. So that's the kind of, and it's a bodily injury claim, but it kind of falls within the scope of this package policy that kind of brings these different components. So if they had an injury and then there was an actual medical expense, then the medical payment max that your policy would provide is that $20,000, and then if there's any other actual like damages that are awarded, that's going to come out of your general out of your per occurrence, and then of course keeping in mind your general aggregate is $2 million. So there's a maximum to the policy and the maximum to the amount of claim that would be paid. So and again, as you look at your policy, I mean, you'll see these numbers clearly defined. And I think as you think about your own operations, I think as we talk about some of the other insurance options that are out there, I think you'll have a better idea. Is there something within the scope of your operations that wouldn't necessarily be covered under a commercial general liability policy that you would then need to think about, okay, how do we manage this risk, or how do we possibly purchase insurance to make sure that we don't have a gap in our protections, or that there's a liability issue here that we have to figure out how we address it. And for example, in the information I put together here, the one thing I'll just say is I didn't specifically highlight it here, but for example, liquor liability is a big issue. So organizations that have an event, say a fundraising dinner, and they are offering alcohol at that fundraising dinner. Usually you would do it, through maybe it's through the caterer, or the venue, whatever the circumstances are. I mean, some organizations actually are offering donated alcohol at an event or at an opening of some sort. There is absolutely a liability issue, even if you have a caterer with a liquor license and their own general liability insurance. The issue for organizations is that liquor, in terms of liquor liability, that's a specialized kind of endorsement that would be outlined within your commercial general liability policy. So sometimes organizations unfortunately find out that having an event with liquor served, if there is some potential accident that results as somebody coming to the event and being served liquor and then driving home having an accident, then they turn around and unfortunately, this is the society kind of issues we face, then sue the organization, blame them, or the venue and the organization. If your policy doesn't include liquor liability as an endorsement, that you will not get any coverage through your commercial general liability policy. And so that's a gap that sometimes a lot of organizations don't even realize they have. When it comes to liquor, it's such a problematic area that a lot of insurance companies don't automatically include that endorsement. So, just to give you kind of that example from an operations standpoint and a gap standpoint, and just from a fundraising event perspective, that's an area that always is recommended to take a close look at and make sure that you don't have a gap in your overall commercial general liability kind of foundational coverage. And so, so as we look at, so you have the GL side of it, third party bodily injury and accident, kind of covering your overall operations, the programs you're delivering, and protecting yourself from possible, issues that might arise, not only physically, but also even from, possible allegations of slander or advertising injury that somebody might claim in terms of what you're doing. So it casts, fairly kind of wide net, but also very specific to those components. When it comes to the board of directors themselves, that's another specialized type of insurance called directors and officers liability. And I think that this is where there's some misperceptions or just misunderstandings. Your commercial general liability policy does not cover your board of directors, and so there's limitations to that GL coverage in terms of protecting the people that are associated with the organization. So in terms of best protecting the board of directors or your trustees, that's where we purchase this more specialized policy called D&O. And so what D&O really is about is protecting the board for their management and governance operations, or decision-making really is what we're talking about. So the decisions that the board is making, and those decisions including managing and supervising staff. So there's two parts of D&O policy. One is the actual protections for the directors and officers. And then there's the employment practices liability aspect, which is obviously addressing employment issues, and the management and supervision of employees, not only by the board, but also for example, the executive director or leadership supervising other staff, volunteers. And so, so that D&O policy is another layer of protection for the board, for the organization. So D&O typically covers the entity, which is the organization. It's going to cover the board and that, them personally. It's going to protect the organization for wrongful acts, where basically they're negligent or there's gross negligence. But if it's purposeful, if it's, it basically, not an accident or negligence, they actually are doing it absolutely on purpose. That's where insurance will you basically bar possible coverage. So that's one thing to keep in mind when you're looking at your insurance policy. If you have somebody who commits a crime, your insurance is not going to cover you for that. If they blatantly, and I don't want to give any examples, but there's definitely a difference between just general negligence or gross negligence and absolute purposeful actions that are meant to cause harm or do cause harm, or are criminal in nature. So that's where you're going to see an issue arise with your insurance policy. But in general, wrongful acts, that D&O policy is going to cover those potential wrongful acts where negligence occurs and the results that might take place that result in actual claim on your insurance policy. And so, probably the biggest issue when it comes to any nonprofit operation, the biggest claim from a D&O perspective is employment related. Probably 60 to 70% of D&O claims are as a result of employment issues, wrongful termination, discrimination, whatever the circumstances. And so, any nonprofit, any collecting institution with any employees, even one employee, absolutely should have directors and officers insurance. An employment claim, just from a legal standpoint, in terms of the legal costs, could cost tens of thousands of dollars if you don't have directors and officers insurance, let alone if there is some kind of settlement. In fact, I worked with an organization recently that had a D&O claim. Their policy premium was $675. The D&O claim was $110,000. And that just shows you kind of, the absolute necessity of D&O and the potential problems that unfortunately arise with employment. Sometimes problems happen, mistakes are made, and that's why we purchase insurance, to protect our organizations. So D&O is really around the governance management decisions that the organization, as a board, the executive director, are making. And it plays a very important part of this risk management structure. And it fills the void where there's gaps And so, sometimes we have organizations say, well, we don't need D&O insurance. We have protection under the Volunteer Protection Act in New York State. So, boards serving as individuals serving as volunteers on the boards, they have protection, just in terms of general negligence in their actions. Unfortunately, that protection is limited, so it rises to the level of gross negligence. You no longer have that board immunity protection under New York State law, but more importantly, you don't have any legal protection. So if you as a board are sued, even if it's completely baseless, no merit to the lawsuit whatsoever, if you don't have D&O insurance, each one of those board members are going to have to hire their own legal representation to get that legal lawsuit dismissed. So D&O kind of collects everything together. The D&O company is going to have a law firm on retainer in case you would have that issue arise. They're going to represent the organization, they're going to represent the board, and if there's any actual claim made where there's a settlement, then the settlement's paid out of the general aggregate policy. So D&O and commercial general liability are probably the most important building blocks of protecting your organization, managing risk, and really allowing you to be successful in delivering mission. So if there's anything you take away from today, it's just knowing, that, whatever size your organization is, these are two areas that, are absolutely instrumental and essential. So having that general liability policy to protect you as you're doing your programs and services and operations, and then having your directors and officers insurance to protect the board and in terms of management and governance decision making. So before I move on to some of the other insurance areas, there's just a question here. Our policy has an endorsement called additional property not covered that excludes historical documents from coverage. This essentially means that the greatest asset we have is not covered. Is there insurance that would cover this? That's a great question. It kind of leads us into the whole area of property insurance, which is a component of a commercial general liability policy. So, we package property insurance with that general liability, and that together makes our commercial general liability policy. So this issue of the historical documents, I'm definitely going to touch on that here in a moment. And then here's another quick question about policies not usually covering volunteers. If they got injured, trip and fall accident, would not general liability cover that like it would for a visitor coming into your facility? We have a large property, extensive lawns, own our own mowing equipment, which is used by volunteers. Should an accident occur while one of them is mowing, do I understand they would not be covered? Would it revert to their personal medical insurance? The mowing volunteers are a combination of board members and non-board members. I obviously can't answer that question, right here, right now, without reviewing the policy. That's really what comes down to. You're going to want to look at your policy document and really see how are volunteers talked about, or are they even mentioned in your policy language? Your broker or your insurance company should absolutely be able to clarify, but in most cases, no, the volunteers would have no coverage. They unfortunately, they are not treated the same from a GL perspective in terms of bodily injury and accident. So that's that gap, that's that potential liability issue that volunteers, that we with our organizations have when we use our volunteers. And so that gets into the more specialized areas of insurance. And so for an organization that's heavily dependent on volunteers, there actually are other specialized volunteer insurance options that are specifically provide accident and medical coverage for volunteers. And they're not expensive. And they, it is one more type of insurance that you would add as a part of your risk management structure. And I'll give you a quick example. I work with an organization that it rehabilitates wolves. They have no paid staff. They completely volunteer driven. And so dealing with rehabilitating, basically the wolves are there forever. They're caring for them. And they're basically are in large enclosures. So they're not completely wild, but they absolutely are, still wild animals. And so there's a lot of risk with that potential activity. And so the insurance company mandated that the organization, in addition to the general liability policy, had to purchase additional accident insurance for their volunteers. And so that was an additional policy they had to add on as another layer of protection for the volunteers, because the insurance company saw that as high risk. In that case, the insurance company mandated it, but that's not always the case. So for an organization, they really have to make in some cases, you really have to review that and make that decision on your own. But I would say, a lot of these issues, unfortunately, come down to limited resources. But at the same time, purchasing volunteer insurance is not a significant cost and is well worth the investment. So I think, just to kind of get to that topic here, but I'll come back to that. So let's just try to move through the property, and then we can get to a little more on the volunteer side. So just on the property side, really what we're talking about is protecting the things we own, our buildings, our contents, business personal property, PPP, the business income side, going back to that earlier question. So this property side is really, the contents, and then business interruption, business income. And so, we add this as components of our general liability policy. Do you have to have property coverage? No, you do not. But it from a overall risk management perspective, if you only buy general liability, you're only going to have liability protection. If you have assets and you don't add property to your policy, you're not going to have any coverage for those assets. So you have to add property coverage, to get that additional coverage component. So some organizations only want a general liability policy with no property coverage, because they just want the basic policy. They don't really have any assets, or they don't have anything that they want to protect from a property standpoint. But having property coverage, has more benefits to it. It's, again, typically not a significant cost in terms of adding on if you're a small organization. But in general, you're looking at a variety of factors, when you're structuring your policy, like deductibles, or also called retention. That has an impact on price. So if you had a loss, you're going to pay $500 or $1,000, depending on your retention. That's a factor, that organizations have to look at in terms of the structure of their policies, especially when it comes to property. And there's other components around property insurance, like replacement cost and coinsurance rules. So there's certain mandates to get, say, replacement cost. Then typically they look at the overall value of that building or item, business personal property, and they mandate you have to insure this at a certain percentage to get replacement costs. So if you only, say, had a building and you were only insuring it at 50%, their insurance company is not going to give you replacement cost in terms of a loss. They're not going to replace the damaged portion of the building with exactly what that material was, unless you meet their coinsurance rules. So that's the kind of detail you just need to be aware of when it comes to property. And I have an organization I work with that has properties that the actual cost, the valuation of the buildings is far greater than the actual market rate of the buildings, and they choose to insure those buildings far below the actual value and more in line with the market, and thus they can't get replacement costs because they aren't meeting the coinsurance rules outlined by the insurance company. But that's a conscious decision on their part, and they feel that paying the additional premium just to get replacement costs is not in the best interest of their organization. That's the kind of decision organizations have to think about and arrive at. Another piece to this is flood insurance. I just added that here because, again, if you have a flood, and I know of a museum, they, in 2006, significant flooding, especially at their facility, their GL policy did not cover any flooding. And as a result, they had no coverage. They did get some money from FEMA But ultimately, after 2006, they then bought their own flood insurance policy because there was a gap. They had no idea, unfortunately, until the flood, and now that's a separate standalone policy that they have in place. And that's, unfortunately, that's not what you want to find out when you have a claim and a problem arise. So now I just want to move more specifically, just to give you some just some consideration as a collecting institution, and it gets to this question about the historical document being excluded from coverage. As you think about insuring your collection, that is a tricky issue and a challenge, just in terms of valuation. I mean, unfortunately for insurance companies, they are number one, there is a distinction between business personal property and fine arts. So, I point that out because some organizations may not realize that their business personal property may not really extend to the collection, and typically does not. Business personal property is really computers, office equipment, the kind of operational elements of your organization. If you wanted to cover your collections, it really is a separate component, usually under a fine arts policy within your commercial general liability and property package, but really is typically separately scheduled within the policy. That just means, it would show up on the policy separately as collections, fine arts coverage. And so part of the problem is, if you have a significantly valued item, the insurance company might mandate an appraisal, for example, and so it is challenging, kind of pick and choose what you really want to cover, and you could never cover fully. For many institutions, they probably could not fully cover the value of these irreplaceable items in terms of your collections, and afford the cost of it. So it's kind of a risk management discussion and consideration. So in terms of exclusions, like the example that somebody had mentioned here, in terms of a historical document, that's clearly excluded from your commercial package policy in terms of property coverage. So is it possible to get it covered? Yes, it is possible, but you'd have to look at a separate fine arts component, or for example, if it was loaned to you, and that may be something that you could schedule under what they call inland marine, which is basically another party's property you're temporarily holding or housing at your organization, like for an exhibit, for example. So there's different ways of looking at of getting coverage through your commercial general liability policy, depending on the circumstances. But again, there's going to be a cost to it. And so for any organization, you would evaluate, obviously it would be, going back to your broker and the insurance company and asking, one, can we get coverage? Because some insurance companies are resistant, or may not want to cover collections. And that kind of gets into the more specialized market around, or more specialized need for looking at markets or insurance companies that actually cover museums and historic sites, collecting institutions, and provide that kind of understand that kind of need and business operation, and have adequate products available, the kinds of things that are meant for collecting institutions. And so, I point out some of this because some organizations may just have a straight, what we call business owners policy, especially a smaller institution that has, commercial general liability and has business personal property, but that typically would not cover your collections. So you may have a gap that you don't even know about, because the broker may not understand the distinction between BPP and collections, and that if that's not communicated to the insurance company, you may not even know that you don't have coverage until you have a loss, unfortunately. And so I just put one other point here around the historic building side of it, the actual cost value versus replacement cost, just for your reference. This idea of that, what I was talking about, replacement cost is actually replacing those things, no matter the cost, no matter depreciation, whatever it would cost, because that's the coverage you have and you're meeting the co-insurance requirements. But if you're not adequately insuring the building, then, and there's a variety of reasons why you may be doing that, then it might be rated on an actual cost value. So they're going to take into account the depreciation. And so you may not get, the kind of coverage where they're going to replace, say, a loss at a historic building. They may not return it or give you the money that will actually return the building to the actual same way in terms of historic integrity and fabric of the building. So that's just something to be aware of. So I'm going to move into some of the other coverages here, and some of these we can move through quickly, but I see there's a couple questions here, and actually let me answer this other question real quickly around the pandemic very quickly. I think let me find that. So right here on this slide, business interruption, which really is something that we find under that it's under commercial general liability package, and it really is related to your property coverage. So number one, if you don't have property coverage, trying to claim a business income loss is not going to be possible from a general liability standpoint. Typically, it's on the property side of the policy in terms of business interruption. So it's for whatever reason that's the way that's the way that the property that's the way that income loss piece is structured on the policy. So keeping that in mind, what a lot of organizations found is that when they were impacted by the pandemic, then they tried to go and make this claim for lost revenue because their operations were halted. Majority of commercial general liability policies had a virus exclusion when it comes to business income loss or that business interruption piece. So they basically, because they had this virus exclusion, they are claiming that COVID is a bacterium or a virus, and thus all that income loss is excluded because of that. And so there are definitely legal cases where organizations are suing their insurance companies. So far, I'm not aware of any of those cases being won. And I think what the insurance industry is saying, if we had to pay all those business income losses, we would be out of business. It would bankrupt the insurance industry and put them out of business. The losses are in the billions. I mean, probably trillions if you add up them worldwide. On the individual, organization side, they of course don't see that and don't agree with that. Ultimately, it really depends on legislation as a solution. And I think that from a government, from a lawmaker perspective, it seems very unlikely that lawmakers are going to make the insurance industry pay these business interruption claims and kind of wipe out this virus exclusion. So at this point, the biggest thing I can say is go back to your policy language, see if you have a virus exclusion, bacterium exclusion. If you do, the likelihood of getting the claim paid for business interruption, business income loss is very zero. I would say it's 0%. The insurance company is going to deny the claim. But if you don't see that virus exclusion, it may be worth filing a claim and just trying to see what results. So I just to point that out quickly for people's considerations. If you weren't aware of that issue and that as an option, it did get a lot of media attention and a lot of people have been talking about it. But you may have not even considered it for your own policy, but it would be something to go back and look at your policy language. And I'll say, if you have a PDF of your policy, that's the best scenario. Then you can search for these words very quickly. And for example, going back to the volunteer coverage question, if you have a virus exclusion, you can look for these things, business income loss. That's the easiest way to kind of look for your policy quickly and kind of look for these keywords. So, and for most insurance companies, they are giving your policies to you as a PDF. and if they don't, then you should request one, and that would be, you know, the ideal way to kind of, you know, get a better handle on what some of these components are in your policy or not in your policy. So I'm gonna, and I'll try to get to some of the other questions here as we move forward. So just quickly on the auto side, I mean, again, separate kind of policy coverage can be added, you know, as another component of your commercial general liability, and really as two aspects. Your owned auto, if you actually have automobiles that the organization owns and has registered, then the organization would buy auto insurance, you know, and that would have two components, liability and physical damage, and that would be the organization. For many organizations, they don't own autos, but they have employees who are driving their vehicles on behalf of the organization on company time. And so that's where a potential gap also exists. If you don't actually have a non-owned hired auto endorsement on your policy, then unfortunately, the individual who's your employee, who's doing business on company time, if they then have an accident and do damage to another property, and then that individual, you know, the property owner then sues your employee, you as an organization, there's no coverage for them under the umbrella of your organization's insurance unless you have this non-owned hired auto endorsement. So the individual, the employee, would kind of be out there on their own on the hook. Now, the distinction here is that the employee's insurance, the auto insurance the employee has still is going to be covering their vehicle. What non-owned hired auto does is cover the employee from a liability perspective under the umbrella of your organization. You know, so personal auto insurance is still going to apply and address, you know, the possible damage to their own car, possible negligence. But when it comes to, you know, the potential liability side of the actions of that employee, and then them, you know, suing the individual that's your employee, and they're, you know, for example, if they had a volunteer in the car and there was an accident and the volunteer was hurt, if you don't have non-owned hired auto, all of that liability is going to hit the individual employee and their auto insurance. So this is somewhere I think a lot of organizations don't understand. They have a gap possibly if they don't have non-owned hired auto. Again, it just provides an umbrella of liability over those individuals who are driving their vehicles during company time on behalf of the company, their own vehicles. It doesn't provide auto insurance in terms of insuring their vehicles, but it protects the individuals as employees doing company business and just like if they were at your organization providing services. So hopefully that makes sense. You know, so if that individual causes harm to somebody else, then your insurance would cover them from a liability standpoint. Let's see. So, and I see, so just a quick one here on D&O. My board has felt the cost of D&O insurance was too high. I'm taking copious notes to share with them and make the point clear that they need to have this type of insurance. If you have staff, I can't say it enough. You absolutely should have directors and officers insurance. Like there should be no question. From our perspective, again, from the New York Council of Nonprofits, dealing with boards all across New York State, even a volunteer-driven organization should have D&O, but it does come down to cost. And if you're going to prioritize D&O versus commercial general liability, you know, for a volunteer-driven organization, general liability is first priority. D&O would be second. If you're a staffed organization, GL and D&O absolutely both first priorities. And I would say there are specialized D&O programs out there that absolutely offer, you know, good price points, but typically you're not going to get away with a policy for less than, you know, $750s, you know, in that range. The market is tightening. And so we are seeing increases across D&O policy insurance carriers across the sector. Nikon has a D&O program. We've seen a slight increase to our D&O program. So, I mean, they're, but D&O, it is a more specialty type of insurance. So it does pay to find a company that is in the business of insuring nonprofits. So there are some D&O carriers out there, I would say, that, aren't necessarily mainstream, and you are going to pay a lot more. I think a lot of nonprofits probably, you may see an average of $1,000. It absolutely is possible to get a lower price policy. Let's see. And if an organization has no employees, does it need D&O insurance? I think I answered that. No, you don't, but it would be a best practice or recommendation. And it just depends on, assets and the organization. But I think it would be definitely a recommendation, from a best practice and just risk management structure perspective. Just hitting on a couple more types of insurance here. Professional liability, maybe not so applicable to collecting institutions, but this is where the organization would be offering, some kind of expertise, holding yourself out as an expert. And so then there typically are professional exclusions on your commercial general liability policy that you would have to address through a professional liability endorsement. And so that would be, just something to keep in mind. That if you had that kind of circumstance, and I honestly can't think of one from a collecting institution perspective, but I guess, for example, say you had a curator that did an appraisal and told an individual, hey, this is valued at this amount of money, and then that person insured it at that, and maybe the person had a loss and then went to the insurance company. The insurance company said this is a fake and it's worth $5. Could they turn around and try to sue your curator who put themselves out as an expert on behalf of your organization? I mean, this to me would be a nightmare situation, but I just give it as an example. If you were in that business in any kind of way, it absolutely be excluded by your GL policy. You'd want to have it addressed through a professional liability policy component. So, and lots of, I mean, again, I don't want to go down the rabbit hole on that one. Improper sexual conduct and abuse, probably more applicable to collecting institutions, especially with educational programs that deal, for example, with kids. This is a very, this is an area where a lot of organizations don't realize there's potential gaps or issues. So if there was an allegation of sexual conduct or abuse, your commercial general liability policy actually almost with certainty is going to not address that claim unless you add improper sexual conduct abuse endorsement, which again is another endorsement you can add on to your commercial general liability policy. Again, additional cost, and it just depends on the circumstances of your organization. You can address some of the risks, obviously, through policies and procedures and good risk management, but if you're doing a lot of kids programs, adding this kind of coverage would absolutely be recommended. And then, of course, umbrella liability, like an overall umbrella policy, which is another layer over your commercial general liability package. And it just adds additional higher limits, without increasing the general aggregate of your commercial general liability. So it's just what it is. It's an umbrella of additional coverage that is in place for potential losses or issues, and again, depends on the organization and circumstances if you would want an umbrella policy, but for larger institutions it's pretty commonplace. So let me just double check here. What about the cost of remediation? Can it cover the monthly storage cost of housing and contents during repairs? Yeah, typically your general liability policy would cover costs if there were damages to the premises, to the facility, of having to relocate, monthly storage, renting new office space. That's typically the kinds of things that you'll find within the structure of the policy and the actual coverage that's provided. Again, it's in the details of the policy, so generally, yes, I would say that's typically what you would see with a commercial general liability policy. If there were damages to your facility, or your collections need to be rehoused because of a fire or something like that. What type of policy covers an electronic art collection, say scanned photos or music saved on a server? That's a great question. Really, that I think is going to be something that you're going to integrate under your commercial general liability policy, under property as a scheduled, more specialized collection. It really would be a conversation with the insurance company, and that's where you may find limitations with your current insurance company, and they just may not have the capacity or the actual coverage structure for a more specialized type of collection. So you may then be looking for a new insurance company or a separate standing policy. I will say the challenge with just trying to buy standalone property policy, for insuring, say, just like a separate collection, is that it definitely is a lot more expensive. It would be best to package it all together. That's the whole idea here, that by packaging the CGL and the property, you're getting more bang for your buck in terms of the premium cost and kind of putting the different pieces together. So when you take property and split it out, that's where it tends to, unfortunately, kind of get into a more expensive structure. But I would say, it's typically possible to cover anything. The general barrier is cost. So that, wouldn't surprise anybody, I guess. In terms of some of the other insurance you may need, I just highlight a couple other policies out there. Crime fidelity, employee dishonesty. That really is related to theft, employees dealing with cash, taking admissions, the check paying kind of issues, that, theft, embezzlement. That's really where this kind of policy comes into play. Unfortunately, again, when you have theft or embezzlement, that's where you find out the gaps in your commercial general liability policy, and typically, those kinds of issues are possibly not covered, or covered, within very limited kind of amounts. So crime fidelity, employee dishonesty are areas you can typically add those on sometimes your D&O policy, sometimes you do it through your commercial general liability policy. But it's an additional endorsement that you kind of package, and that's the ideal way to do this. Same with business interruption. In addition, you can add additional business interruption endorsement, or same with extra expense endorsement. These are typical. These are areas, sometimes organizations are more manufacturing, I would say, but business interruption has gotten a lot of attention because of COVID and the pandemic, and especially in terms of not being, not paying any actual claims. But extra expense, is that example of where an organization is incurring additional costs in excess of their normal operating expenses, because of an impact on the organization, damages or an accident, and so they have to wait for repairs and replacement before they can get back up and operating fully or normally. They are having extra expenses, so extra expense would pay for those. And usually you're going to see these within the scope of your commercial general liability policy. So again, look at your policy language, look for these kinds of components, and in that way you'll know if they're there or not. And if not, then it would be having a conversation with your broker and your insurance company about adding them. Cyber liability, probably one of the biggest areas that people are absolutely looking at having in place. Again, can purchase it as standalone, but also you could add it typically to your commercial general liability policy. There's the couple of components: notification, expense. That's that, if you had a data breach or a cyber breach issue, The notification expense will be covered in terms of notifying all the parties impacted. It can be very expensive. How would you ever do it? That's a key part of having cyber liability. And then the liability side of it, if anyone sues or there's some kind of damages, then those would be awarded. And again, this is where a gap could occur. Many general liability policies are including some basic cyber liability now. So just look at your policy language, and that's where you'll know what the limitations are. If you don't see cyber liability included, then you really want to go back and have a conversation with your broker and insurance company about adding it. Fiduciary liability, this is really, around the assets of the organization and possibly mismanagement, protecting an organization, the same kind of issue, theft, embezzlement, but more from, maybe like a retirement plan standpoint, or, the treasurer of the organization, possibly stealing money, that fiduciary liability is typically an endorsement you would add to your D&O policy. Employment benefits liability, more around maybe like a health plan, an employee benefits structure that the organization has. Much larger organizations typically have this. It would be additional protection for the management of those employee benefits. And then participant and volunteer accident coverage. I talked about this. This is a gap for many GL policies. It is something to investigate and really think about, paying for if you are dependent on volunteers doing a lot of extra services or like lawn mowing. Definitely would be worth looking at volunteer insurance and purchasing that just for peace of mind, and definitely not a high expense. And the last one, builder's risk, is really related to construction. If you were under construction or renovating a building, you really would want to look at a separate builder's risk policy that is really meant for buildings under construction and that are not occupied. And so it is a more specialized type of insurance that, again, you would investigate depending on if you are in those circumstances or need that. So I'm just going to try to take a couple of the questions. Let's see. What about objects in transit? So objects in transit, again, the commercial general liability policy, you could definitely build that in. You can actually get an endorsement for fine arts in transit. You could look at an inland marine policy that could help address those objects in transit. But typically it really is going to be something under your CGL policy as a component of that package. So you'd want to be specifically asking, to, again, having that conversation with your broker and insurance company to ensure that when you have a collection item that's being loaned to the organization, or you're loaning something, for example, and it's being transported, that as long as you are the one transporting it, or it's being transported, and you're the one making those arrangements, you're going to want to be clear who's actually covering it during that transit. And so if it's not the actual owner, for example, or if you're the owner, you're going to want to make sure that that object is covered, until it's in the hands of that other party. And that would be specifically identified in your commercial general liability policy, typically through the fine arts coverage. That's fairly typical. They will actually notate on the policy some kind of level of coverage related to objects in transit, or like an inland marine type of coverage. And inland marine really is this idea of transporting something, and it doesn't sound applicable, but in this circumstance it would be property in transit. How does one value an irreplaceable item? Great question. That's such a huge challenge and issue. It really is around, I mean, you could try to appraise it. The problem, of course, again, we don't want to value our collections, but if we want, from a best practice, we don't value our collections. We don't treat them as assets, but from a best practice, we can't purchase insurance unless we don't have some kind of general value. And unfortunately, for most insurance companies, if we told them this object's worth $100,000, they probably are going to ask for some kind of documentation or appraisal. So that's a great question. I think you kind of have to weigh the most high profile items you have in your collection. How can we best cover them? If you can purchase an overall fine arts a level of insurance, and just keep in mind, okay, this $50,000 or $75,000, for example, fine arts coverage is really for these high profile items. Or you may want to get an appraisal and try to outright schedule that specific irreplaceable item separately on the policy under your property, and see what the cost might be. Here's a question: if I'm understanding correctly, our inland marine policy covers archival collections for which we serve as a repository. Ownership is claimed retained by another organization. Well, for which we serve as a repository, but would not cover archival collections we own. Yes. And again, not seeing the policy language and not knowing the very specifics of your policy, that is definitely a fair assumption that the inland marine policy would most likely cover those archival collections that you're holding, that you don't own them, but you're storing or holding them in the benefit of somebody else, as a loan or what other circumstances. But your actual owned collections would have to be covered under some other component of the policy, like fine arts. And again, you could get that clarification very easily from your broker and from your their conversation with the insurance company, or looking at your insurance itself. Your collections, if you are looking to cover your actual collections, should have some kind of component outlined in the policy. And again, not typically, it's not the BPP, it's not the business personal property. So just I'll move to a couple more questions here in a second, but just managing your policy itself, it really, most of the policies are written in a similar format. You're going to see different components. So the deck page, deck relations, that's where you're going to see all the key info, the overview of you as a named insured, the effective dates, coverage, the limits of liability, the price, the renewal, all of that is right there on the deck page. And that's the most important information. Then the policy itself, that's where you're going to see the definitions. So they're going to get into the terms within the policy that are how they're defined. What's a volunteer if they define it? What's the insured? How do they define it? That language is going to be helpful. Then there's the actual insuring agreements, and that's where the insurer describes what the policy covers. There's the conditions section where it talks about the duties of the insured and the duties of the insurer and how the policy will respond depending on what might happen. And then the endorsements and exclusions. And that's what I was talking about earlier. Like if you had a liquor liability endorsement or an exclusion, or maybe it doesn't even talk about liquor liability, but that's where those endorsements that you add onto the policy, you're going to see them identified. The exclusions that are not going to be covered, like covering the board of directors, or typical exclusion. The exclusions like a virus related to the pandemic. You're going to see that kind of language outlined in those areas. Another big component of insurance is certificates insurance, your COI, and this is really, it's a document that's conveying the existence of coverage at the date of the certificate. And so it's a regular part of doing business if you're using somebody else's space, or for example, if you're taking a collection item on loan, that individual or organization that owns it is going to want a COI that is saying, yes, I'm covered, you as the institution, collecting institution, I'm covering it, it's covered under my policy, and here's the documentation and proof. And we're naming you as an additional insured. So that's this whole area of certificate insurance. And this is a very tricky area. A lot of regulations and a lot of mistakes are made around certificates of insurance. So you really want to be careful, that for one, your broker fully understands COIs, and really, it understands, for you as an organization, you understand the limitations of COIs, and also the additional insured aspect, that there are some limitations to naming someone or an organization as an additional insured. And so, it basically, that COI really is proof. It's an important tool that you have of showing somebody else you have proof of insurance, and you're either protecting the institution or the asset that might have a tie, or that if you're using another facility, that you're additionally insuring that other facility through your own insurance policy. So that's how we do that, through certificate of insurance. And this is just a screenshot. If you think about the certificate and the additional insured piece, this is the kind of thing that you'll see. And typically you can add additional insureds to your policy, and that's a part of the, when you put your policy in place or renewal, you could have that conversation. If somebody is saying, I need to be additional insured and I want to be reflected on the policy, you would have that conversation with the insurance company. But typically we do it mostly through certificates of insurance. And then the biggest piece here, claims, incidents, accidents. If something happens, typically you're working through your broker, you're notifying them, they're notifying the carrier, or you can notify the carrier directly. There's two options. And so there's always a question, what do we have to notify our carrier about, or a broker? If something hasn't happened, for example, there's been some kind of legal threat, you kind of have to manage that process and think it through. Just reporting the incident doesn't, it doesn't really affect your policy premium. Just because you bring up a possible incident, nothing happens, doesn't hurt you. So you just, don't be afraid of reporting issues. But ultimately you want to be very clear if there is, any threat of legal action or actual bodily injury accident or whatever the circumstances, you absolutely want to notify your carrier immediately, and or a broker to notify the carrier on your behalf, whatever process you're following. But that is so important, because if you don't take that action and you think that it's a minor issue, unfortunately, these things can lead to much bigger issues, especially if there's any kind of lawsuit or suing that occurs. Because there's the actual accident, but then there's a whole other repercussion side that can really put an organization in a very difficult position. And that's why you pay for insurance, and that's why you shouldn't hesitate to use your insurance. And so, just to point out on the renewal side and kind of the premium aspect, typically your policy, the premium is based on a rating basis, and that's really how they figure out the cost, the underwriters and the insurance company. And so they might be looking at your overall income. They might be looking at the number of people you serve, the square footage of your building. Those are all different factors. So, really just understanding how your policy is rated. And then if you have a change, it would be notifying your broker or the insurance company so they can adequately adjust your policy. And just understanding, so, I deal with organizations that have the same policy structure for the last decade, and that's very problematic. They find out they have lots of gaps in coverage because they have not updated, and their policy hasn't adapted and been reflected of their current operations. So, unfortunately, your policy doesn't grow with you. You really have to feed that information into the insurance company to make sure you have a policy that adequately reflects and addresses your organization. We're obviously, I'm going to try to cover a couple of these questions. We're at the end, and I'll try to wrap up. I just have a couple wrap ups here, and then we'll see what we can do for questions if people want to hang out. Just a couple more points. Special events. This is another tricky area for nonprofits and collecting institutions, more specifically, in terms of those special events and programs you're holding. Again, just because you hold the event doesn't mean the insurance company necessarily may cover the event. They sometimes, there can be a disconnect. And I know, for example, of a museum that has chainsaw carvings at their event. if they had an accident with that chainsaw carving and the insurance company wasn't aware of that event with the chainsaw carvings, that's going to be a huge issue for the insurance company. So we really have to make sure that we have these events covered in terms of an endorsement on our policy that really shows that, are they aware of this event? Hey, this event draws 5,000 people. That really needs to be on the radar of our insurance company. And sometimes insurance companies will reflect those larger events specifically in the policy endorsement. So really, making sure that your insurance company is aware of the scope of events and what you do really is in your best interest in protecting the organization. Because that's, unfortunately, where you suddenly have an event and there's some kind of activity happening at it the insurance company has no idea about, and then you may find that the insurance company is going to deny a claim because it was never reported to them. Now, sometimes that can be the fault of the collecting institution, or it could be a fault of the broker, and so that can be a challenging situation you don't want to find yourself in. And this is just a kind of an example of an endorsement that kind of shows fundraising events endorsement. Here's all the fundraising events that basically we're going to exclude. But here's basically we're going to cover fundraising events, but here's the ones that are the exceptions, like fireworks, firearms. So this is the kind of thing that would be good to see in your policy, an overall events endorsement. So look for that in your policy itself. And then finally, just generally working with your broker and the industry, the broker is a partner with you. You want to find somebody who's dedicated, communicates well, timely and following up, especially, in terms of working in advance of renewal, notifying you about changes, helping you with certificate of insurance. On the client side, you as a collecting institution, understanding your policy, communicating with the broker, having the policy information in front of you, reviewing it at least annually, and including the information, making sure your share updates and changes. It's a two-way street. So the more you are working with your broker and insurance company, the better, you're protecting the institution and of course your collections. And then just some general takeaways. Only one broker can approach a company on your behalf. So if you wanted a quote from an insurance company, only one broker can make that request. Another broker can't go to that same insurance company and make a request on your behalf. So just make sure you understand that kind of first come, first serve type of a way things work. So if you have a broker you're working with and you want them to go to a specific insurance company, you wouldn't want to ask another broker to go to the same insurance company. So it's just the issues with the industry. They'll only work with the first person that comes to them to request a quote. Most carriers won't offer you a quote midterm. They don't like to, offer if you canceled your policy midterm, typically they don't want to offer a quote right in the middle of that canceled policy. Again, depending on the circumstances, you might be able to address that. It depends carrier to carrier. And then the one thing is that carriers will quote out up to 90 days in advance of renewal. They typically won't go more than 90 days, but as you're thinking about your own renewal, you can absolutely work 90 days out. So if you were going to shop your insurance, you can start getting quotes 90 days in advance of your renewal. You don't have to wait until 30 days. You can work out at least 3 months. So that's a typical way most carriers work. And then there are premium thresholds, minimum premium thresholds that carriers have. So even though you might be a small organization and you only want say you only want $5,000 of property coverage, you may find out that $5,000 of property coverage is going to cost you $300, which is really a premium for $10,000 of property coverage, but that's the minimum premium threshold they charge. And that's just the way carriers work. So you may want to just say, oh, well, we'll take $10,000 in property coverage then. So just give that example to you. So I do apologize. There's a lot of information and obviously lots of questions. So I just want to try to get to a couple of these questions and as quickly as I can. So coverage for objects placed in external storage, rented storage, where we have no control over disasters there. Is this a separate endorsement or covered by inland marine? So you would want to make sure that storage facility is covered under your commercial general liability policy. And so it would be treated as another location. So you actually would show on your policy another location. So, number one would be maybe your main facility. And then number two would actually be the rented storage facility. So it wouldn't be an inland marine policy. It would actually, you would have that as an actual recognized second location, and then your coverage in terms of, however you're covering the objects in storage, fine arts, for example, you would want to take into account those collections in the rented storage facility and just make sure your overall coverage accounts for it. So hopefully that answers that question. It's actually, that's very common, organizations that have multiple buildings or may have a rented storage facility. It's another scheduled location that you would indicate on your policy, on your commercial general liability policy. So it would be listed on the policy, the actual second address of that rented storage facility. So if you don't have that on your policy right now, absolutely get that on your policy. That's the first step. What kind of insurance do you recommend for a nonprofit that does small events, music, and a yearly festival for their town? We were recently told we have to have insurance for each crafter. What kind of rider would cover this situation? So, I mean, for your kind of circumstances, that would really be a general liability policy. That's really what you're looking for. Just a general liability policy that would cover you for your events and operations, and for the use of, for example, if you're using like the park of the local town or something. And then what kind of, for the crafter side of it, that really could also be covered as a part of the general liability policy as well. It just depends on what they mean by crafter. If it's somebody like, for example, a broom maker, then that would be a presenter on behalf of your organization. You would just want to make sure that the GL policy kind of covers the scope of your operations. And then I'm not exactly sure who's telling you have to have insurance for each crafter, but it would depend on what they're asking for. That would be documentation. Most likely it's going to be a certificate of insurance showing the scope of the policy. And then you might have to list the crafter on it, I guess, to satisfy their demands. That would be a conversation with your broker and insurance company. So hopefully it gives that some direction to you. So absolutely, general liability policy is the direction to go. Can I get compensation for slow response at time of disaster, like notify of flood and call back is 4 days later? That, if you're talking about your broker, I don't know, probably not. That goes back to good, partnership, good brokers. That's a tough question. I mean, you could argue with your insurance company and see if you incurred more expenses, that would be the case to make. I wouldn't go the direction of slow response time. I think it would be in making an argument that you have greater expenses, maybe that they aren't paying for. So maybe that gives you an idea. So I think that's it then. And apologize, ran over a little bit here, but hopefully everyone had some good takeaways, some information that you can work with for your collecting institution. And again, you have my emails in the presentation. Happy to be a resource. And thank you for joining us.